Unless specifically indicated otherwise, the content expressed are my views only and not necessarily those of Lifeco Asset Management, LLC. The content presented is in no way an investment advice, solicitation, or an offer to sell securities or investment advisory services. The material is provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. I cannot assure the accuracy or completeness of these materials. As such, the information in these materials may change at any time without notice. Reference to these discussions about IULs and annuities or fixed insurance products. Investments on fixed insurance products are different from investments in the stock market. Any guarantees provided by a fixed insurance product cannot be assumed to be guaranteed for any other investment.
Welcome to the Rock My Finances show on K4HD Radio and Talk 4 TV, where we put the fun in finance. Join Powerhouse Jennifer Jose, CDFA, CMC, and Private Wealth Advisor, as she collaborates with you to create clarity, control, and confidence with your money, your way. It's not about the zeros, so what is it all about? Let's find out. Now here's your host and weekly friend, Jennifer Jose.
Hey, I am so excited about today. I am here at Miss Juliet Cardona's office. I love her. She's my partner in crime. We do so much stuff together, and she's in the Bay Area. So I just drove up yesterday from Beverly Hills. It's going to be an amazing day. We are going to share something with you that is absolutely life-changing. And I promise you, I know everybody says all the time, but I swear, you're going to want to stay till the end. You're going to like, share, download, share with your people. This is very important information. Even if you've already heard it before, which I doubt you have, but if you have, you're going to want to save it because we do a little spin on it as well. So this is obviously called Rock My Finances, right? And so it's called Rock My Finances. We care about your money. We care about your relationship with money. We care about your mindset with money. And we want to create our wealth. We want to create it. We want to keep it. We don't want to lose it in the market, and we don't want to give it to Uncle Sam. And we also want to spend it and have a really good time. Like I just bought these new lashes, right? I don't know if you guys are all into lashes, but I'm into lashes and I love them. I know they're a little crazy, but they're good for the video. So money bought that. How much do I love money? So yes, can money make me absolutely happy? In my belief, this whole podcast is my beliefs. Anything over $75,000, yes, it can make you happy. Up into $75,000, it's a necessity. Like you need to have it for food, shelter, medical, all that. So depending on where you're at, that's where more joy comes from with more money. I hope that makes sense. That's my 2 cents. So here I am going to introduce Miss Juliet Cardona. Come on, beautiful.
I love being in person with you.
This is so fun. This is so fun. This is really fun. And so Juliet and I have been working together for how many years? 8 or 9. Oh my gosh. 9? I'm old as hell now. And
you're gorgeous and vibrant as always.
And she's young and keeps me young. And I just love our relationship. So it's really fun. So we are going to share with you something today that we really try to implement into financial planning. We're both financial advisors, financial planners, wealth advisors, whatever you want to call it. And so we want to make sure that our clients have a comprehensive plan. We want to make sure that they have diversified buckets of money everywhere.
Our favorite term.
All right. Love
buckets.
It. Love buckets. We want everybody to have lots of buckets. If you're on video, you're wondering, I have my cute shirt. She believes she could. So she did. Yeah, go ahead.
I was ready for you.
Yeah.
So she did.
So she did. I love my little t-shirt and I love it. And sometimes that's all it takes. Refrigerator open. Mm-hmm. She just got me ice. And we can hear them binging in the background. This is what happens when we're all live, right? And so I love quotes and mantras and sayings like this. I like to have a sign as well. And that helps us remember we're kind of badass, y'all. Like
sometimes we forget.
Sometimes.
All the time, most of the time.
Daily, right?
That's true.
Something can whack us off our path and interrupt our juju, as you always say.
Oh yeah, my juju, don't mess with that.
Don't mess with my juju. Exactly. So this is going to change that for you because this is going to be the foundation of your financial wealth. Anybody?
Foundation people.
Right? Are we getting excited yet?
I hope so. They should be.
I know, right? So you have to stay on the end. It
doesn't sound very sexy though when we're talking about the foundation of something.
I know.
But I promise that, again, it's just like doing the work ahead of time, like visualizing the plan, putting the plan in place. It's all of that leading up to whatever bucket you're trying to get going, right? Whether it's what we're going to talk about today or some of the alternatives we're going to review today. The point is, it's bigger than just the bucket, right? It's the why. And I think that's why today it's a great place for us to jump off and start, because we're talking about foundation. But it's also more than that. It can be sexy. And I think that's where really what we're going to focus on towards the end, because there isn't a perfect investment. You taught me that 8 years ago, and I used to fight you on it. And in a specific instance, this is the perfect investment. And it's great to learn as you go, right? You find out that it's not a one size fits all answer, whether it's, a tax-free bucket like we're talking about today, or a future taxable bucket, right? They have pros and cons. So I'm excited for us to dig deep. I'm gonna play devil's advocate with you. We didn't even talk about that before.
I'm going to too.
Maybe some controversy.
Ooh, I like it.
Just a little, right? And
I like it.
I think it'll be a really cool discussion for your listeners to really get an idea of what you do to help people, because we don't always talk about the foundation part.
That's very true. So can we call it financial foreplay?
Ooh, that's sexy.
You don't have to have it, but when you do, it's a hell of a lot more fun and it lasts longer. Just saying.
Does it affect the F word?
F word is my favorite word. Y'all know.
We haven't even said it yet.
No, we haven't. F word, feelings, but there's other F words as well. Just saying. Okay. So we don't want to freak out Juan out there. It's so awesome. So what we are talking about, I'm going to play this little exercise with you. Okay. You ready? I have this bucket. And you can invest into my bucket, okay? You don't have to pay any taxes on this money. So you're going to give me money and not pay any taxes. So it's pre-tax dollars. It's going to go into this bucket, okay? This bucket is going to be for your retirement. So you cannot touch this bucket without a 10% penalty plus a state penalty, which California is 2%. So that's 12% penalty until you're 59 and a half. So you have to put money in here every month from your paycheck all the time, and you can't touch it. Okay. That's great. It's for your retirement. Now, you don't have to pay any taxes on it. It's going to grow what's called tax deferred. So no taxes during the growth period. I am also going to give you this bucket back when you're ready, say like 60, 65, but I don't know how much it's going to be. And before I give it to you, I'm going to take out a chunk. Could be 20%, could be 30, could be 40, could be 50.
Hang on. Yep. So there's penalties if I want it sooner.
Yes.
And if I don't take it sooner, Jennifer, I still have to pay you money?
Oh, yeah.
Even if you've had it for 30 years?
Oh, yeah. And I'm not going to tell you how much it is until that time.
Ooh.
And it's going to grow because it's going to be invested with the stock market and stuff. But it could go down. In fact, with history, the stock market has always gone down. It's always come up. I love investments, love the stock market. Got to say that. But this investment, you have no idea if you're going to want the money when the market's down or if you're going to want the money when the market's up. We have no idea. And I don't know how much I'm going to keep of it. And I'm not sure what it's going to be. I don't know anything. Are you excited about this bucket?
I'm not going to lie to you, no.
No.
Doesn't sound very sexy.
Yeah.
Doesn't get me going. Doesn't get my feels excited. If anything, I feel like it feels like there's a lot of red tape, maybe some anxiety because I felt like I had to memorize what you said about when I might want to touch it. And I also don't know what's around the corner, right?
You don't know what you're going to be doing at 59 and a half?
Not really.
Okay.
Considering I'm 30.
Yeah, right? So now let me give you another bucket choice. Like you said, you love choices, right?
Let's see it.
Here's another bucket.
Okay.
You have to pay taxes on it now. So whatever your tax bracket is now, you know what it is.
Yep.
You're going to pay taxes on it. It's going to go into a savings account, just like all your other money does, right? Then you're going to give it to me for this bucket. This bucket is also going to grow tax deferred. So no taxes while it's growing. Same way.
Okay. So I paid it and then it's left alone for a while.
Correct.
Okay. I'm with you.
It's also going to give returns like the stock market, but you're not in the stock market, so you cannot lose your money.
Well, that sounds too good to be true. Keep going.
And if 5 years, 10 years, you want to take your honey to a trip around the world and you want to pull out some money, you can do that. So you don't have to wait till 59 and a half.
So I could access it if I'm 30 now, I could access it when I'm 40.
As long as there's enough money in the bucket, you can access it. You can be your own bank.
Okay, we're coming back to that later, but I already liking it at least a little bit more than bucket number 1.
Okay. Oh, good. I like it. Bucket number 2. So with this bucket number 2, we would set it up like it would be a long-term. It is a long-term situation. Over time, it is going to be amazing. This actually can help you in your retirement, as our retirement planners that we are. We have you have this bucket in retirement. So bucket number 1, if you're going to go pull money out of it, I'm going to take a chunk of that, right? Because it's a retirement account. It's a 401k, an IRA, 403b, 457. It's a retirement account. The government is going to take taxes. We just don't know what it's going to be.
Right.
Our bucket number 2, no taxes come out of this bucket as long as you have it structured correctly by really smart, beautiful women. Just saying.
Just saying.
Just saying.
They are
So structuring it great, you will have a tax-free retirement income stream.
Hang on. You didn't even say income stream with the last one.
No, because I don't know if the money is going to be there, and I don't know how much is going to be there, and I don't know how much taxes you're going to pay. So I can't tell you that's going to be an income stream. It's going to be a bucket for you long term, but I have no idea what it's going to be. History has shown us you should be fine.
Right.
But this is fine.
Okay.
Okay, here's the kicker.
I'm with you.
It is this bucket of money is wrapped around with a life insurance policy. So you also are going to leave a legacy. Is that important to you at all?
Yeah. I don't know if I want to have children for sure, but it's definitely important for me to feel like I'm leaving something behind to make some kind of impact.
Some kind of impact. There you go. Perfect. It could be to the horse world. It could be to the animal world. It could be to
my trust dog fund.
Your trust dog fund. I love it. So this one lets you leave a legacy. So bucket 1, it's called a retirement account, 401k, IRA, 457, 453, all of that. Anything that's pre-tax dollars. You don't pay any taxes on it now. And that's supposed to be the gimmick. But I can tell you, do you think taxes are high or low right now?
Well, they feel high every year when I file my tax return, right?
They do. And when you look at the tax bracket history, are we high or are we low?
Am I me or the client?
I know, right? So we're actually really, really low right now, y'all. So just Google income tax bracket history.
And then for fun, check out marginal tax rate in the U.S. history. And that'll give you more of like the averages of where the actual American is falling. And it shows you kind of weeds out a little bit of the 1% part that's changing the narrative there, right? So marginal tax rates too is something that I always love that they look for. So
yes, that's
sorry
perfect.
To interrupt.
Love it, love it, love it. And so when you look at that, we actually are on the lower end of taxes. And I think you all know about the debt ceiling they're talking about right now in Washington. And I think you kind of hear about that a little bit. In fact, Juan's going to show you we are?
Yeah, we have to
I think we have to hit share screen. I don't know where that is.
It's present.
Oh, present. You're awesome. So we're going to show you right now what's called the U.S. National Debt Clock in real time. So if you're driving or whatever, when you have time, go look at usdebtclock.org, I believe. And so you're going to see how much we're clicking. It's just continuously growing. With our debt continuously growing, we absolutely have to raise taxes down the road. Like it's just the way it is. It has to. Don't worry about it.
Yeah, it's not going to work, but I can tell them. And it is .org.
It is .org. Okay, great.
And
it's
right
at
now
4 trillion or 31 trillion.
31 trillion, 7.
You can't
31.7, y'all.
Yeah, there y'all.
Okay,
we're
so
in the trillion.
Closer to 32 than 31 trillion dollars.
And that's not coming down. It's going up every second. So check that out. So if you don't believe us that we're saying taxes are going to go up. So when you put all this money, pre-tax dollars into this amazing account and you're growing it, it feels really, really good. Like I have a friend that has $1 million in her 401k in her retirement account. It's amazing. But what happens if the taxes are 60%? Then you actually only have $400,000 in your retirement account. Can you live on $400,000 for the rest of your life? Or do you need that $1 million? So let's pay taxes now where we can control it. Any other control freaks out there?
Controlling, just a little.
So I want to know what's happening now. I want to know where I'm at now so I can plan from here. So that's the one thing about taxes. We want to pay taxes now, like we used to say from Brentwood, the cornfield area.
Mhm.
We would pay taxes on the seeds of the corn stalks instead of the entire, what's that
Harvest.
called? Harvest. Exactly. The
Yeah.
whole harvest would pay much more taxes. So pay taxes on it now. This also might be sounding something like, what's the other thing that we pay taxes now and let it grow and come out tax-free later?
Oh, that thing that Senator Roth invented called the Roth IRA.
Woohoo! And I know the Roth IRA has gotten a lot of press over the last many, many years. And
Great
a lot
press.
of great press. And a lot of people do know about the Roth IRA. We love that.
Mhm.
We love the Roth IRA. It's great.
Fantastic.
What's some good points about it?
I mean, like we covered before, but to reiterate, right? You're paying taxes now. So we're paying taxes on the seeds. Then as it's growing, we're not getting taxed. And then in the end, once we're 59 and a half, we can pull it out with no penalties or taxes, right? So that's sounding really good to me.
I like
right?
it. I like it.
So instead of paying it on the premiums that are, well, now I'm jumping ahead, but again, paying it on the seed versus the harvest.
Awesome. What's the downfall of the Roth IRA? ROTH IRA. What's one of the downfalls?
You're capped on the limits, right? I believe it's 6,500 this year. So that's not very much money if you are getting serious about retirement and you're in your 40s and you're saying, hey, I want to put a large sum of money aside so that I can, you name it, right? Travel the world, visit my grandkids, help my children with college, help them buy their first house, first weddings. I mean, those are things we hear every day on the daily. So
6,500 ain't going to be doing much.
That's really not like, that's not even going to book you very many wedding venues, at least in our area, right?
Yeah, that's
so
true.
It's going to be a drop in the bucket, right? And that's the biggest drawback that we see with Roth IRAs. Like if a client comes in, it's excellent that they have a healthy balance in there, right? But they soon realize that either they get priced out of it, meaning that they start earning more money.
Oh, what? So what happens when you earn too much money?
Oh yeah, Uncle Sam doesn't allow you to contribute money to a Roth IRA. They restrict you.
Yes. So everyone out there right now that's making too much money, which is usually in the mid six figures, 150, 125.
Married couple, if you're thinking you're around like 200,000, that's where you're going to be looking at being phased out of the Roth IRA. That's where they start saying, instead of 6,500, you could put 2,500 in, right? And it starts becoming a pain in the butt. Your CPA's got to do all these calculations and things.
So we have bucket A for you instead of the Roth IRA. That's why we call it the Super Roth.
Right.
So our bucket A is the Super Roth. Like we love it. And it's extremely flexible as well. So if you have a Roth IRA, that's awesome. That's great.
Yep.
If you're married couple, spouses, one has one doesn't, that's fine. That's wonderful. You want a tax-free bucket in retirement for sure.
Yes.
That's great. And if you want to put more into it and supersize into it versus a retirement account versus your 401k, 453, 457, for all those, instead of doing that, pay taxes now and do our Super Roth so that it can come out tax-free later. We are going to always give you the pros and the cons, like we said. Mm-hmm. So what is one con from our bucket A, our Super Roth?
So one con is that it needs time to grow.
Yes, it does. So it is a turtle. It is not the hit the right stock and make $1 million overnight, right?
It's not a get rich quick strategy by any stretch of the imagination, right? Even when we have somebody come in with a large inheritance and they want to set one up, it's still a process and it takes time.
The minimum we've done is putting premiums in for 5 years. And so we can structure one that we're putting money in for 5 years and then let it grow for the next 10, 15, 20 years. That's fine. But we have to, it's a long-term, it's a tortoise, right? It takes a little bit of time.
Now, I want to make something clear. You can go online and they'll sell you single premium life insurance policies all day long. So when we say we're not setting it up that way, it's not because we're uneducated or don't realize that it's an option. It's because when you look at the way most policies are structured, and I'm talking about the policies that are structured for accumulation purposes, right? So they are literally structured to compound at a faster rate than the same style of investment, right? So they're all called, An indexed universal life is what we're talking about. We'll talk about some of the alternatives in a moment, but if it's one indexed universal life insurance policy is not equal to the next. So again, coming back to how much money you want to put in and how often you're going to contribute to the account, it's important to look at how it's structured. Because yes, you might be able to physically do it on paper and do one lump premium into the account and watch it grow. But typically you're going to see that the amount of expenses early on don't make that worth it. And if you simply divide that chunk of money up into, 5 years,
10 years, whatever
you're
you
going to
want.
see how that compound effect will actually work better, right? And that's something that we run for clients all the time, right?
And then we
It's
educate
showing
them for sure.
Right. And it's their decision.
For sure. And
I've had a couple people do the single premium route just because it was easier and it was less taxing. And that was the position they were in. But like Jennifer says, if we want to talk about the best way for this to work for you, we're looking at a 5-year premium situation.
Exactly. And that's one way to structure it. Like Juliet said, that's the way we're structuring it. We can structure it many ways.
They're very flexible.
They're very flexible. Like we have, I have clients doing a couple $100s a month, and I have millionaires doing $250,000 a year.
You ready for this?
Yeah.
It puts the F in flexible.
Oh, I just love her when she's all sexy like that.
I don't know where it came
F
from.
in flexible, another F word we love. And
I just heard it.
Isn't it not just so flexible? I love it.
Well, and that honestly is what makes them, that's a con, our next con. Sometimes they're so flexible, it's hard to understand all your options, especially as an insurance buyer or as a client. And that's why when Jennifer said earlier, you need 2 beautiful, sexy ladies to help you with these policies, you can pick not pretty ones. That's fine. But the point is, you may find that having somebody besides that 1-800 number to call is going to be really, really helpful. Again, we don't know what is going to be around the corner, right? And if big goals, big dreams happen, 7 years down the road, and you're going, hey, I've got this large sum of money in that account, Jennifer, what could I do with that?
Right.
There's options, right? So we're talking about, or we're focusing on using this account, this bucket, right, to compound and be there for retirement. But there are a lot of ins and outs to how they work and what makes them so flexible.
I love it. I love it. And it does get confusing. It also, clients come to it, it's too good to be true. So here's another con.
That's a con.
Right?
Mm-hmm.
There are fees. This is not free.
No one works for free. There's no free lunches.
Not at all. So there are fees, which is why this is a long-term investment, because the fees come out first. So in the first 7 to 10 years, depending on the structure of the policy, you will be paying fees. Now, if you keep that, if you were only going to do it 7 to 10 years, the fees would be too high and it would not make sense.
Right. And that's, again, the first 7 to 10 years, we're paying the taxes on the seeds, right? We paid Uncle Sam when we got our paycheck, right? The taxes already came out. And then after that, it's going into the account. And then there's a little bit more fees there, right? Like we just said, and then it grows. And that is where, when you look at how the account grows, there's a lot of pros, which I know.
Exactly. When you go long-term and the fees come out first, and then you go long-term, it's more like a safe investment. So what this is doing for you is it's growing your foundation.
Yes.
Your financial foundation. It's safe, it's secure, it's building the foundation of your house. Do you want it on wood? Do you want it on slab? Whatever you want. It's a very strong foundation for your house. Then you can do the stock market. You can do bonds. You can do crypto. You can buy houses. You can buy business. You can be a venture capitalist. You can do all that to build your house. Each wall is a different bucket, which would be amazing for your beautiful house. This is the foundation that is secure. Right. Talk about secure. Talk to me about the difference of, say, the stock market when money's going up and down versus, or banks. Oh, hello.
Ooh,
banks
versus
an insurance company.
Given this week and a few weeks ago as well.
Yeah, way back when we were like, get a CD. Like that's what we were told all the time. And now banks are, having that worry again. Like it's not as bad as it was in 2008, but the bank is having worries again. So,
but let's talk about that really quick. Like, so Jennifer, let me play the client and ask you, how safe is my money if I'm putting, potentially hundreds of thousands of dollars into a policy like this because I want it to be significant by the time I'm drawing on it. How safe is it? And I'm not saying is it safer than a bank, but the question is how safe, and how, as a client or a buyer, would I go about even figuring that out?
How does that make it safe, right? Yeah, I totally
Right.
get that. Thank you for that question, Ms. Juliet. That's a great question to have. So banks, you might all know, that are insured by FDIC, insured by the government for $250,000 per person per registration in an account in a bank. So the government insures money in your bank. So that leads people to think that that is the
safe.
best thing ever. It's all safe. It's all wonderful. Then we have people storming our Capitol. Then we have people not knowing what the heck's going on in Washington. So how safe is the government? Well, we haven't fallen. We're a good company. I mean, good country. Good country. We are young, per se. Has there been other countries with trouble? Yes. But have they always pulled out of it? Yes. So that is the bank side. The insurance company's side, first of all, have to have more money on hand because they are required to be able to cover death benefits. Permanent life insurance policies, they have different rules and regulations than banks do.
And they're actually stricter, just so you know.
Yes.
If you want to get into the nitty gritty and look it up, you will find that the insurance companies are held to a higher standard than the banks. Because if you think about it, right, and I don't like putting these things out into the universe, but it's important to talk about a situation like 9/11, right? There were hundreds of thousands of people who passed away. Hundreds? Tens of thousands? Tens of thousands? A lot, right?
Yeah,
in New York, who passed away. And every single one of those insurance policy claims was paid.
Yes. And that's what insurance companies do. They band together and insure each other to make sure that the industry is extremely safe.
Right.
And secure.
It's not a run on the insurance company. I've never heard that. I've never seen that in a headline, right? And there's a reason for that. And you can look more into that if you wish, but it's
or give us a call.
Give us a call. We'll explain it, right?
And then
but it's important to know.
Yeah, I love that you said that they paid all the claims for 9/11. They absolutely
did. Actually did.
And they didn't have
to because it's an act of God. It's terrorism. That's all listed in the policy.
Right. So they didn't have to, but they did
not. But they knew that would shake the faith of the insurance company
the whole
if
industry.
They didn't.
Yep.
Right.
Yep.
And again, that goes to show that they don't just fold and fail.
Exactly. They band together and pull each other out, which I love that. So on the safety side of it, then we have the doomsdayers, right? Well, what happens if the government collapses? What happens if there's a recession? What happens if, nuclear war, or we have another terrorist attack and San Francisco falls off in the ocean, or
all the
earthquake, whatever, all that. And are you going to, I love what Rob says, are you going to pull up your account and go, how's my IUL doing when you're getting stormed by terrorism or any of that crazy stuff? You're not going to care about investments at that point. You're going to want a gun and some water and good people around you, because that's not going to matter at that point. So if you're a doomsdayer, we don't care what Apple's doing today. If it's, if it's a whole doomsdayer, and if it's not, we still want to set ourselves up for later in life. And that's what we do. Oh, ding, ding, ding. Another positive on bucket A.
Okay, let's hear it.
It has what's called living benefits. So if you get chronically critical, terminal illness, each one structured differently. So you need to discuss with your person, preferably us, what you would like.
I love it.
There is a money bucket for you to get to before you pass away. So you actually have your own little separate care bucket that you can reach into. We had a friend of ours who had cancer, and he reached into his IUL bucket to travel to Germany in order to extend his life for a while.
And get some more treatment.
And get a different type of treatment. And he did. And we don't always have that 50 grand lying around. And so you can actually pull that out of your life insurance death benefit early. So there's another perk to it. Okay. Perk, pro, con.
Love it.
What would be another, let's see, any complaints that we might have besides? A lot of our clients need to understand that this is a foundation long-term. It is not a short-term get-rich scheme. Now, we did great in the stock market in 2020. We doubled our money. We did amazing. Rob's amazing. We have buckets there as well. That's great. Shout out, Rob. And so you can make very good money. We're not saying that. However, right now it's down. So when it's down, we still have our foundation growing because you cannot lose your money. If the stock market drops, you just get zero. But if the stock market's 5, you get 5. And it is called indexing. So we will play a commercial. And then Juan's going to tee up the commercial right now. He's our amazing engineer.
Thank you,
and
Juan.
then we're going to play the commercial. And then we're going to come back and talk about what the heck is an index?
And how does this bucket actually make money?
Yes.
We've talked about pros and cons, but how does it work?
Right? What kind of money does it really make? And how can we benefit from that? Okay, Juan, I'm ready for the commercial anytime you are. I know I didn't give any notice on that. So you just cut us off anytime you want.
Wait, the show isn't over yet. There's more fun and finances ahead. Jennifer will be right back as we have a special bonus offer for you right here on Rock My Finances, broadcasting live on K4HD Radio and Talk 4 TV.
Hey y'all, it's Jennifer Jost. Are you ready to transform your relationship with money? Rock My Finances Club is your weekly mastermind for wealth empowerment. Join me live for your personal weekly group video sessions and access your personal portal with the video library at any time, including your success system and way more bonuses. Go to rockmf.com for your financial empowerment. Make yourself a priority today. Schedule a chat with me at rockmf.com and achieve your feminine financial freedom finally. Oh, and don't forget to ask me how to save 50%. See you at our weekly mastermind.
Okay, Rock My Finances on K4HD and Talk 4 TV is back. Once again, let's put the fun in finance with your host and weekly friend, Jennifer Jost.
Okay, we're back. Are you ready? Juliet, what is an index?
Well, where to start? I usually like to start with explaining a mutual fund because most people are familiar with a mutual fund, right? But for those of us who are going, oh gosh, let me pull out my phone and Google it, a mutual fund, as Jennifer taught me so many years ago now, is a basket of companies. It's a basket of stock of hundreds of companies, right? And you're buying, if you buy a mutual fund, you're buying a share of that fund, right? So there could be hundreds of shares, right? And the fund's going to go up and down, and you as the investor get to own a piece of that fund and be able to, with a small amount of money, be able to diversify across hundreds of companies potentially, right? Depending on how big the fund is. So you're spreading some risk, but you're also able to participate when it's winning or when it's losing. Now, the difference between a mutual fund and an index is that an index, well, first of all, it's sold through an insurance company. Okay. So we're not buying this on the S&P. You're not going to go out and just buy an insurance company index.
So that's separate. There's separate indexes.
Yes. And the best way to explain it is that it works very similarly to that mutual fund. So you can buy an indexed universal life insurance policy and participate in, say, the S&P 500, right? Or the Russell 2000 within that policy. You have choices. And again, that's going to come down to what carrier you choose and what they offer, right?
Don't worry. We educate you on all that.
Yeah,
you get to choose your own index.
We
so
don't
worry.
expect you to come to us having all of that solved.
Yes.
Right. But I think, was that a good?
Yeah, that's great. So an index is like she said, the mutual fund, it is looking at hundreds of companies. So you actually get diversification. Each index is like a basket of companies, just like she said the mutual fund is. So when you go to sit down and do your policy, we will educate you on which index is doing well now and what we think we'll do for each year. Normally, the insurance companies will let you change indexes every year, every anniversary.
On the policy anniversary,
on
right? I just got an email today. Hey, you've got a window. Would you like to make any changes? Right?
Yep, that's perfect. Now, there's some insurance companies that actually will let you lock in a rate. So like right now, if your index, say it's up 6%, you can actually lock that in right now in case it goes down before your anniversary date. So you don't need to know what any of that means. Just know that they're lock-in ones as well.
And really, what is that? It's one of our other things. It's not an F word, but it gives you control.
We love that.
We love control. And I love it, right? It gives the policyholder a chance if they're logging in and they're watching things and they've got an opinion about where the market might be going. It gives them the freedom to say, hey, Juliet, you know what? I really like where the policy's at and we're in the positive, right? Maybe we're at 8%. Maybe I'm not sure that the market's going to do anything better than that. And 8% is all I need to feel good about where this account is going. We can lock that in.
It
and
can
that's
even be
a
4%.
huge feature. That's
Yep.
a newer type of thing that we're seeing in products.
Strategy. Love it. Love it. Love it.
There we go.
And everyone's different. So
yes,
everyone has a different threshold of risk is what we say, right? What's your risk tolerance? You might have heard that before. That just means when are you going to freak out and throw a brick through Juliet's window when the market goes down? Like,
Right.
Where's your risk? Can you lose 5%, 10%, 20%? Can you not lose anything? And
Right.
then how much do you need to gain to structure your lifestyle the way you want it to be?
yes.
Do you need 3%, 4%, 10%? Do you need the Ferrari to get there? Like, what
Right.
do you need? And so that's your risk tolerance. And that's our job. We help you figure out what is your comfort level in investments. That's another reason why we love the IUL, because it cannot go down. Once you get that 8%, 6%, 5%, 4%, whatever it is, once you get that money on your anniversary date, you cannot lose it. It stays there. Let's say the index crashes and you get nothing. You just get zero that anniversary year. You just don't lose any money. They don't take anything away.
Real life scenario, right? We're sitting down with clients right now and we're reviewing their life insurance policies, and we're also reviewing their stock portfolios at the same time, right? And I have to tell you that most of my clients want to talk about the life insurance policy, and they're like, I don't even want to look at that account right now, right? It's not doing those exciting things that it was doing just a couple years ago, right?
Right.
And so again, it's coming back to that F word of foundation. This is the foundation of the plan. So on the years when the stock market's taking off and running, they're going, yeah, okay, that account's fine, but what's my account doing that's growing rapidly? What's that one doing, right? So again, it sort of gives the insurance business a little bit of a bad rap, just because they're a little bit more of a tortoise, seemingly they're more of a tortoise on the years that the stock market's taking off and having double-digit returns. Right. But then you have years and scary times, banking crises and things like that. And all of a sudden you're not so confident in that account.
And so you want an F word foundation. You want
speed brakes, right?
Yes.
Like, where's the e-brake?
Yeah.
How do you control that?
I can see you pulling it and spinning around.
I mean, the only e-brake in an investment account, right, is to do some sort of option, which has risks and fees associated,
For sure.
or to pull out and go to cash.
Which is all bad.
Which is a whole other situation, because then when do you get back in?
Right.
I'm going to leave it at that for today.
I wish I had a crystal ball, but you're right. Okay. So that's good. Okay. So even if I don't, as the client, really completely understand indexing and all of that, you're going to explain that to me, right? Every year you're going to explain it.
We're going to go over it every year.
Every year, because this is a very new concept. Now, the life insurance is concept as well, right? So we go over what's the difference between term, which a lot of people have, which is term,
like
renting insurance, or permanent insurance, which means when you die, someone's going to get money, period, no matter what.
Well, and think of that too, right? I mean, term, you're renting the coverage for a period of time, a term of 10 years, 20 years, 30 years, whatever you signed up for, right? On that date. If you're going the permanent insurance route, you are buying this policy on you for your whole life, right? And it's honestly a little bit more of a commitment than buying a house, because the whole goal is to be on you for your entire life. And as we used to say, die with $1 in the policy. So, right,
yeah, that'd be great.
Put a ton of money in, and we want to take as much as we can out. And Uncle Sam's rules are we got to die with money in the policy
in order for it to be tax-free. Exactly. So we definitely have to have a death benefit at the end. So here's the criteria. If all of this sounds good to you, check it out. Go to rockmf.com. That's rockmyfinances.com, rockmf.com, and get on a quick 15-minute call with me and or Juliet, and we will see if you can qualify, because here's one big con. Sorry, y'all.
Oh, we did save this one, huh?
Yeah, we did save this one. You have to qualify. So
what does that mean?
Right? You have to be healthy, or someone that you are financially attached to has to be healthy in order to have this type of a policy.
Yes. So diving into what that means too, right, is you're going to go through underwriting. A literal underwriter is going to be sitting there reviewing your medical history, your driving records, and seeing what you look like on paper. Okay. So if you're sitting there going, ooh, not a good time for me right now. Maybe you've got a spouse that you can insure. And I know, again, back to us control freaks, you can actually be the owner on a policy that is somebody else's the insured, right? So we're business partners. I could buy an insurance policy on Jennifer. People do it all the time. And if she were to kick the bucket, so I'd be paying into it, right? And if she were to kick the bucket, you're not allowed to, dang it, then I would get payment for that, even though it's on her life, and she could do the same thing on mine. Now, granted, obviously, we're going to be aware. We're signing documents. We're signing
you
waivers,
do a whole
right?
buy-sell agreement.
But it's something
like it's
that we've seen very often, especially in spouses where one spouse is very healthy and the other one isn't. There's options there. So I did want to say that yes, we need a healthy body. Doesn't necessarily have to be yours.
Right.
Okay.
We just have to be financially attached, and it has to make sense to the insurance companies. So I have a client right now that we were going to do, I think, 25 or 30,000 a year. And so we are going to lower that a little bit because her husband doesn't have as much insurance as we were going to have on her. So we have the bucket, and then we have the life insurance policy wrapped around it. So it's very, very flexible. You could do $250,000 wrapper. You could do a $5 million, $10 million, $20 million. Now we only have about 5 minutes left, but I want to tee up two things. The first thing is I'm going to tee up Miss Juliet. What happens if, which we get all the time,
yes,
I just inherited a crap ton of money.
Right.
I know nothing about money. I feel guilty because I inherited it from my family.
Passed away, right?
Who passed away, and I know nothing about the stock market. It scares me to death. I don't even want to know any of that, and I have no idea who to trust. Is this the right bucket for me, or is there another solution? Tee up part 2.
Yeah, I'm going to say that that's a loaded question, right? I mean, everybody's situation is different. Just because I know that this person inherited a ton of money, it doesn't give me any of the specifics on what they want out of that money. So I can build a great plan all day, but if that doesn't resonate with you and where you're taking your life and what your goals are, it's not a good fit. That's where it comes to the long-term foundation. We just have to get nitty-gritty enough to know how you want this money to work. And I would put like a 10-year thought hat on for that.
Yep. I love it.
You don't have to have all the answers. We're very skilled, I have to say.
Yeah, we will help you get there.
Helping you find the right amount. The last thing we want to do is overface someone with an investment or insurance policy that they cannot afford to continue to do.
Or doesn't even feel comfortable. Absolutely.
That's just, no.
So there's a couple other superchargers on our Super Roth. So So there's one that I'm going to say puts a jet pack inside your car. That's called Kaizen. Mm-hmm. So get in touch with us about that. Good
luck spelling it.
Right. I know. But it's amazing. That's what we're doing for my daughter Journey. And Miss Juliet, do you have, you went straight to premium finance.
Straight premium finance.
Okay. So then now
I ran the numbers.
Like a double jetpack or something. There's also that you can do as well, which is called premium financing. So there's lots of different solutions out there other than a 401k, which is all we ever hear out there. And that's what our main purpose is here. Because what I'm finding is after I've been with clients for 10, 15, 20 years, they're retiring. They do not want to pull out of their IRAs because they have to pay so many taxes. So they're limiting their lifestyle. That's what we do not want for you. We want to have a tax-free bucket so that when you're not working every single day and you want to go take a vacation or take up an amazing hobby of, say, painting or golf. Hello, I'm a golfer and it costs a lot of money to golf. So when you're doing that, we want to make sure that you have a bucket that you don't have to think about to pull money out of. And in the meantime, I have a client who pulled money out. It's as a loan, which we will explain to you as well. But she loaned money to herself in her policy to buy a Tesla. So she could have done the financing through Tesla, but this was way cheaper and she's paid herself back. So you can be your own bank as well. Whoop, whoop. I know. You can be your own bank
Next time,
as well.
everyone, I cannot wait to go through part 2.
Yep. So we have 4 minutes left. Let's talk about why people would be apprehensive.
Oh, yeah.
Right?
Commitment. Commitment of phobes, right? Commitment of phobes.
Well, what happens if I say yes today and then say 2 years down the road, I'm scared because I don't know what it is? What happens then?
We meet and we talk about it.
Awesome. So there's flexibility, the F word.
Oh, yep. That F word's back, right? We meet, we talk about it. We figure out what's life like now, what changed, right? We built a plan that looked good day 1, but what was the difference between day 1 and year 2 or 3 that we're in?
Okay.
Right. And we start there. And then there's tons of different options. We could scale down the policy, right? We could change how you're funding it. There's honestly a lot of options. even though that's not our goal when we're setting the account up.
Right. So like someone could lose their job. Like I did have that with a client, which is very, very rare. I haven't had one at all, but they lost their job and could not pay the second year. So what do? I even actually had a family member who got laid off. So we just lowered the premium. So there's lots of different flexibilities that you have. Now let's do it on the cons or the pro side. What happens if you set it up today to put in, say, I don't know, 5,000, 10,000 a year, and then I step into inheritance next year?
Right? Well, that's going to depend. If we filled the bucket up as much as Uncle Sam allows us to, then the
new policy,
right?
But if I didn't,
if we hit hard times in year 2 and we had to scale back our funding, the good news is there's this thing called backfilling, something that you don't see with retirement accounts, right? If I didn't have the money to put it in last year and it's now the next tax year, I can't do it.
You lose it.
Right? So that's where, again, that F word of flexibility, that I think we're hammering it because it's undervalued.
No, I get, yeah. I forgot about that backfill. That's totally awesome as well. So it's so flexible with your lifestyle because like as Juliet is a youngin here, she doesn't know what's happening when she's 40.
No,
she has no idea. And this policy is a long-term thing. So we love that it is flexible.
Right? I'm sitting in a position, if I need money for future kids that I haven't even decided I want to have yet, it'll be there. And I know that. Right? And it'll also be there if I decide not to have kids and go be a horse mom and go buy me something fancy. Right? It's flexible.
That's awesome. So if somebody wants to talk to you, Miss Juliet, how do they find you?
JulietCardona.com. You can book a time with me there. The first one is complimentary. And I would love to see how we can help you build a tax-free bucket.
Awesome. I love it. Thank you all so much for this amazing day. We love talking about this. Absolutely.
Honored to be back.
Love her on here. And we love talking about this because it's helped out so many clients. So we hope we didn't hammer it in too much.
Hopefully we didn't bore you with the details.
Check it out.
Keep it fun.
See if it's for you. And this isn't for everyone because you have to have money consistently. So you have to have, like, we don't present it to just everyone. You have to have a good, consistent money. You have to have discipline to stick to a plan.
And the desire to be in control now of your money, to be able to have the patience to let it grow over time. So hope you loved it, but I've had my bucket. I've had several of them. I love them. They saved my life forever. Thank you all. I want you to be able to say, I rock my finances. I rocked mine
like none other. And we'll see you next podcast. Bye.
Bye.
We appreciate you joining us today, and don't forget to subscribe to the Rock My Finances YouTube channel for more engagement and bonus content. Tell me, what is your money story? Let's find out with Jennifer, 4 p.m. Eastern, 1 p.m. Pacific, every Thursday right here on K4HD Radio and Talk4 TV. It's not about the zeros, it's about the F word, feelings. Feelings Jennifer can't wait to explore with you next week. Until then, let's all say, I rock my finances.